Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. My name is Manpreet, and welcome to this week's edition of our Through the Noise podcast, which regular listeners will know takes a look at recent developments and puts them in a long-term context, but also identifies potential opportunities for more nimble investors. Now, before I get to today's topics, I wanted to point out that yesterday was Information Overload Day. Now, admittedly, this is a somewhat niche event, but it's very relevant to investors given we usually face the challenge of too much rather than too little information. So this week, to help me sift through the information overload and focus on what matters, I'm joined by Audrey to discuss a couple of key topics, right? One is whether equities positioning has gone too far. Second is whether US bond yields can rise further or have reached a nearer top. And third, of course, the outlook for the Japanese yen and sterling. So welcome, Audrey, and why don't we get started on the equity market side? Now, we've been discussing the fact that many indicators of positioning, including our own proprietary diversity indicator, they're selectively arguing that markets may be due a short-term bounce. But how should our listeners reconcile this with a weakening long-term growth outlook? Are you getting any signals from the nascent Q3 earnings season?
Well, there is an ongoing tussle between the still robust US economic growth and rising bond yields. And thanks to the largely positive earnings performance this earnings season so far, we've seen global stocks rebounding from key support levels, which has been tested thrice over the past 3 weeks. About a fifth of US S&P 500 members have reported earnings thus far, and of which about 3/4 of them has beaten consensus expectation versus the long-term average of around 2/3. Results so far as well has also been quite positive. We have seen margins remaining largely resilient, and companies are still being able to pass on higher operating costs to consumers. However, underneath these headline numbers, we do see rising challenges to corporate earnings. For one, earnings in Q3 and certainly most quarter this year as well have also been propped up by pretty stellar energy sector profits. And as a bank, we do have a preference for energy equity sectors globally. However, if we were to exclude this sector, US Q3 earnings likely fell by 3.6%, according to Refinitiv. And we also see rising wage pressure and higher borrowing costs as likely to hurt profit margins as well over the coming quarters. Therefore, we see a rising risk of downgrades to earnings estimates in the coming quarter. And in the meantime, the US 10-year as well as 2-year government bond yield has continued to surge higher. And this raised the risk of further derating of equity markets in our view. Therefore, we do believe that the bar for a sustained rebound in equity market is probably low until bond yields peak or at least show some form of peaking. And technical charts also suggest that the S&P 500 will need to break decisively above 3,800 for a sustained rebound or sustained uptrend, and with the next resistance at around 4,100 levels.
Thanks, Audrey. I wanted to pick up on the point you made about rising borrowing costs. And clearly, the fact that the 10-year bond yield has moved past 4% hasn't made things any easier. And of course, there's several reports of how unprecedented bond market losses have been, at least compared with recent history. Do you see the 10-year heading to 4.5% or higher?
Well, the US 10-year Treasury yield has surged past 4% this week and is now approaching a key resistance at around 4.14%. In our assessment, the move is largely attributed to a stronger than expected inflation print, both coming out from the US as well as the UK. And that basically fueled further expectations that we'll get more hawkish central bank, particularly a Fed. And we can also see that being reflected in the move higher in the Fed terminal rates to about 5% by May 2023, as well as investors' positioning data that's continued to remain net short in terms of US Treasury bonds. So certainly a move towards further up towards the 4% level remain possible, and we see technical resistance at 4.14% as well as 4.34%. However, from an investor perspective, we do continue to see such rise in yields as opportunities for investors to add to high quality investment grade corporate bonds, given a very attractive yield on offer now.
Okay, so moving, over to China. Unsurprisingly, there's been a lot of focus on the ongoing National Party Congress and particularly on President Xi's keynote. From a financial market investor's point of view, what really stood out for you?
Well, I see two investable takeaways from President Xi's recent comments. Firstly, the continuation of the dynamic zero COVID policy will likely be a headwind bearish to our 1 to 3 month outlook on CNH, and also making a move towards 7.3 as well as 7.35, which are key resistance levels, are more likely. The second point is the focus on key core technologies is supportive of our China hard tech and semiconductor sub-theme on the long-term horizon. And now, if you look beyond the Party Congress, Asia US dollar bonds have basically took a beating following reports that Beijing has warned local government-backed companies against debt finance land purchases. So that's certainly a negative news. But having said that, the impact from this to Asian US dollar bond may be limited, given that if you look at China real estate weight within Asia US dollar bond benchmark, that's only around 3% as a whole. And if you look at it in terms of high yield, it's about 15%. So what this suggests to us is that the past week of underperformance that we've seen in Asian US dollar bonds was slightly exacerbated by poor sentiment as well as poor liquidity. In terms of equity market, it has reacted in disappointment so far. We've seen the MSCI China equity markets testing this year's low, and certainly, increasing geopolitical risk in the form of US semiconductor export restrictions also did not help either. But that being said, we do expect Asian ex-Japan equities to outperform global equities over the next 12 months, given the starting point of much more attractive and cheaper valuation today, and also easier China policies. And if you look at investors' positioning as well, those do look quite stretched as well based on our proprietary investor diversity measures, which argues for room for a rebound to exist in the short term, though over the longer term, we probably need to also see a turn in the US dollar before we see some of the relative underperformance in Asian ex-Japan equities to be unwind.
Thanks. And finally, maybe two relatively quicker questions on FX. First, on the Japanese yen, is 150 the near-term peak, or are we likely to see a move beyond that as well, possibly with some intervention?
Well, 150 was the level that we've seen in US dollar yen back in 1990s. And over the past week, we've also seen Japanese Finance Minister Suzuki commenting several times that he is watching quite closely the FX market and is concerned about the one-sided move in yen so far. And that has basically led to speculations that we may see another round of interventions by policymakers to support the yen. Our view is such interventionist move may be sort of a temporary relief for yen for the time being. However, given the very stark divergence in the Federal Reserve as well as BOJ's monetary policy, we do believe that there is likely to maintain upward pressure on US dollar yen over the next couple of months. And we also see 150.40 as a near-term resistance for yen, followed by a stronger resistance level of around the 155 region where US dollar yen is concerned.
And secondly, on the pound sterling, we've obviously had some fairly dramatic political developments yesterday with PM Truss's resignation. Does that impact your view on pound sterling at all?
Well, clearly it takes away one thing that the market is worried about, but it doesn't really change the long-term fundamental picture for us where the GBP is concerned. While the new UK Finance Minister, Jeremy Hunt, has reversed a majority of the previously announced tax cuts, we do believe that more painful spending cuts will likely be needed in order to balance the UK budget. And if you combine that with the ongoing cabinet shake-up in the UK, that basically raises the overall political risk for our pound. And from a fundamental perspective as well, the pound's recovery to close to pre-budget announcement levels also potentially underestimate the damage done to investors' confidence, as well as from the underlying weak economic backdrop as well. Therefore, while we do not rule out that pound can potentially retest the 114 level, we continue to remain a net seller on GBP, given some of these risks that I've just highlighted.
Okay, thanks very much, Audrey, for helping guide our listeners through what continues to be a volatile investment environment, but also for highlighting the opportunities within that, clearly on the two currency pairs we discussed, but also in terms of the investable opportunities from the policy events in China, high quality bonds globally, and of course from equity market positioning. So thank you, listeners, of course, as well for joining us today. Just to point out, if you haven't heard these already, we also separately recorded a Through the Noise mini-series of podcasts discussing different areas of Q4 Outlook in detail. So please do have a listen for those for longer-term context and also where we see opportunities amid these volatile markets. We'll end it there. Thanks for listening and wish you a successful week ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.